The Alpha Horizon. Thinking different, acting aware.
Hi everyone, I'm Alberto Gallo, Portfolio Manager for Global Credit at Algebris. In this podcast, I'll guide you through the possible post-pandemic economic scenarios, the options governments and central banks have, and the choices to make on financial markets to get ready for this new environment.
Pandemic, economic crisis, and the impact on markets. Where do we stand now?
The good news we need is the vaccine. And so far, we have pretty positive developments on that front. First, most vaccines against COVID-19 have demonstrated to be effective, both against the original virus and the new strains. And secondly, production and distribution is accelerating. This is particularly happening in the US, which has vaccinated close to 10% of the population, and the UK, which is above the 10% of the population so far. Continental Europe is lagging behind, but it will likely catch up later in the year. So we expect for developed markets to reach herd immunity around the middle of the year or perhaps in the second half of 2021. The situation is a bit slower for emerging markets where distribution is slower and we may have herd immunity only in 2022. However, overall, we could see a gradual reopening of the economy starting to happen between the middle and the latter part of 2021.
What can governments and central banks really do right now? What can we expect from the Biden administration?
Policymakers have hit COVID with a double punch. First, central banks restarted QE, quantitative easing, buying assets across bonds and equity markets, and bringing interest rates to record lows. And second, governments initiated the biggest post-war spending plan on record, with double-digit deficits in the United States and high single-digit deficits in Europe in 2020. This has been enough to create what looks like a V-shaped recovery in the market. However, what we know from looking inside the economy at the differences between large and small firms and various parts of countries and populations is that the recovery is actually K-shaped. There is a winner-takes-all effect, and to rebalance the economy, there is a need for micro policies, not only for large-scale, one-size-fits-all measures. Today, the Biden administration has a real chance at implementing these policies to boost growth and sustainable recovery. So far, what we know is a plan to spend $1.9 trillion, which is being discussed currently and may be approved by the end of the first quarter. However, of this plan, a large part is a band-aid against the scars that have been left by the COVID crisis. Stimulus payments, unemployment insurance, childcare, and aid to states, as well as education grants. This helps to sustain the first hit from the crisis, but it will not boost productivity and competitiveness sustainably. The most important part of the Biden plan will come in Q2 and will probably be implemented in the second part of the year. This is the infrastructure stimulus, which should boost productivity, investment, not only in infrastructure, but also in green energy, will improve access to education, and will invest in new technologies, which could be a game changer for the next 5 to 10 years. So the most important question for investors is, will the Biden administration be able to beat or at least dent secular stagnation to create a sustainable plan to boost productivity and competitiveness in the United States?
What will the consequences be if these policies cannot achieve their objectives?
Our job as portfolio managers is to hope for the best, but at the same time we prepare for the worst. We have exposure to an upside scenario where reforms manage to boost organic growth and inflation, and central banks are able to normalize their policies. In our view, the best way to position for this type of scenario is with convertible debt, bonds that have out-of-the-money options to the underlying equity of their issuers, which become in the money in an upside scenario of faster growth. But at the same time, we're very aware that the reforms from the Biden agenda are very ambitious, and the track records of governments really changing the structural way an economy works is sparse, and it will take a long time to see the results. As a result of this, we continue to also position for an environment of financial repression where interest rates will remain low and below inflation. In this case, we look for the best bonds that are able to generate carry for our investors above inflation, as well as retaining a good portion of our portfolios in liquid assets, which create optionality in sell-offs and enable us to buy when other people are selling. Thank you for listening to this new Global Credit episode of our podcasts. We will keep on with our comments on financial markets and the impact on public policies with all their possible scenarios. Stay safe and good luck for 2021.
The Alpha Horizon. Thinking different. Acting aware.